We need to look at the numbers right now because the setup on the charts is signaling a massive shift in market psychology. It is Saturday, December 6, 2025, and while the market is currently closed for the weekend, the closing data from the last session tells a complicated story that you need to hear. Tesla Inc., trading under the ticker symbol TSLA on the Nasdaq, finished the trading week at exactly $454.96 per share. The stock saw a slight upward movement of 43 cents, or roughly 0.095% in the final session. While a move of less than 0.1% might seem negligible to the untrained eye, the consolidation we are seeing right around this $450 level is building a pressure cooker of volatility that is likely to resolve violently in one direction or the other very soon. When you look at this price action, the immediate expectation for most retail traders and mainstream analysts is that Tesla has hit a ceiling. The narrative being pushed in the financial press is that the company is ridiculously overvalued, with a price-to-earnings ratio sitting near 300, and that competition from BYD in China and legacy automakers in Europe is finally eroding the company's dominance. You see the headlines about big short investor Michael Burry calling the valuation absurd, and you might feel inclined to agree that the stock is due for a massive correction. That is the expectation, that gravity must eventually take hold of a stock that has defied it for so long. However, the reality is far more nuanced and potentially explosive. What the bears are missing, and what the raw data is starting to show, is that the market is no longer pricing Tesla as a car company. The market is quietly, but aggressively, repricing Tesla as a distributed utility and an artificial intelligence infrastructure provider. The stagnation in the stock price over the last few days isn't a loss of momentum. It is a transfer of inventory from weak hands to long-term institutional holders who are looking at the energy storage margins and the rollout of FSD version 14.2, not just the number of Model Ys sold in California. If you're sitting there checking your Robinhood app or looking at your SoFi investing dashboard, you might be wondering if you should take profits or double down. To answer that, we have to look at the volume profile. During the last few trading sessions, we have seen a decrease in selling pressure, despite the negative headlines about valuation. This indicates that the sellers are exhausted. When you see a stock refuse to drop on bad news or high-profile short seller criticism, it is often a sign of underlying strength. In the world of online investing, sentiment is everything. And right now, the sentiment is shifting from how many cars can they sell to how much software can they license. This is the pivot point where the expectation versus reality dynamic creates opportunity. The expectation is a slowing automaker. The reality is a burgeoning AI monopoly. Let's analyze the institutional activity because that is where the real money moves. If you track the flows coming out of major brokerages, you will see that while retail volume has been somewhat sporadic, the dark pool activity suggests accumulation. When you look at Fidelity Investments or Fidelity Mutual Funds, the rotation is evident. Fund managers are under pressure to chase performance, and with the broader tech sector facing headwinds from high interest rates in late 2025, Tesla's unique position as a cash-rich entity with zero net debt makes it a safe haven, ironically enough. This is a concept that often confuses people new to self-investing. They assume high PE means high risk, but in a market where growth is scarce, investors will pay a premium for a company that can grow its energy division revenue by 27% year over year, which is exactly what Tesla is doing. If you are using Interactive Brokers trading platforms that allow you to see depth of market, you would have noticed massive buy walls stepping in every time the stock dipped below $440. This is not retail traders buying Robinhood fractional shares with their spare change. This is institutional capital defending a key technical level. We need to talk about the energy sector because this is the specific catalyst that reality is preparing to unleash against the bearish expectations. For years, the energy business was a footnote. Now, with the Megapack deployment scaling up and margins in the energy sector surpassing 30%, this division is becoming the profit engine of the company. The expectation is that auto margins will continue to compress due to price wars. The reality is that the blended margin for the entire company is stabilizing because the energy storage business is so incredibly profitable. If you use Schwab Intelligent Portfolios or other automated investing sites, your algorithms might not be picking up on this segmental shift yet because they look at top-line revenue aggregation. But if you dig into the quarterly reports, specifically the Q3 2025 filing, you see that the energy division is effectively subsidizing the auto margin price war, allowing Tesla to bleed out its competitors without destroying its own cash flow. This is a strategic advantage that no other automaker possesses. Furthermore, the macroeconomic environment in late 2025 is playing a fascinating role here. We are seeing a stabilization in interest rates, which generally helps capital-intensive industries. However, because Tesla has such a strong balance sheet, it is less sensitive to rates than a company like Ford or GM. If you are looking for investment help or reading analyst notes on Fidelity wealth management portals, you will see a consensus forming that the rate sensitivity argument against Tesla is weakening. The company is funding its own growth through free cash flow. This brings us to the AI narrative. With the rollout of FSD version 14.2, which utilizes end-to-end neural nets, the data collection advantage Tesla has is becoming insurmountable. The market is beginning to wake up to the fact that FSD is not just a feature, it is a labor replacement technology. If the company achieves unsupervised FSD by the end of 2026, as the bulls hope, the valuation models used by traditional analysts on SoFi Active Investing or Fidelity brokerage platforms break down completely. You can't value a company that replaces human labor in transport using a standard automotive PE multiple. This is where the tension lies. The stock is hovering at $454.96 because the market is paralyzed between the old valuation model, car company, and the new valuation model, AI, robotics. Every time the stock dips, believers in the AI narrative buy it up. Every time it rallies, strict value investors sells it down. This compression is why the volatility is about to explode. If you are engaged in individual brokerage account management, you need to watch the $460 resistance level. A clean break above that, accompanied by volume, would signal that the AI narrative has won, and we could see a run towards the all-time highs. Conversely, a break below 430 would suggest that the market is rejecting the robotaxi thesis for now. Let's pause for a second and look at the broader ecosystem. If you are using Fidelity ETFs or holding broader tech indices, you are already exposed to this battle. But for the direct shareholder, the question is about time horizon. Are you trading the weekly swings on Robinhood stock trading, or are you holding for the 2030 vision in your Fidelity IRAs? The strategies are totally different. The short-term trader needs to be wary of the gamma squeeze potential here. Because so many people are betting against the stock via put options, any positive news, say a regulatory approval for the cybercab in a new state, could force market makers to buy stock to hedge their positions, driving the price up vertically. This is a mechanic that users of Interactive Brokers platform tools see often in highly shorted stocks. I want you to take a moment and think about your own position in this transition. Comment below how many shares of Tesla you currently hold, or if you are waiting for a pullback to enter. I am genuinely curious to see if the sentiment in the comments matches the bullishness we are seeing in the institutional dark pools. Also, let me know if you are using Robinhood Cash Management or a traditional bank to hold your dry powder for these dips. Now let's look at the company's core business model for those who might be new to the stock or using investment apps for the first time. At its heart, Tesla designs, manufactures, and sells electric vehicles and energy generation and storage systems. They operate in two main segments, automotive and energy generation and storage. The automotive side includes the Model 3, Model Y, Model S, Model X, and the Cybertruck, along with the upcoming Cybercab. The energy side involves solar energy generation and energy storage products like the Powerwall and Megapack. But looking at past performance reports from 2023 or 2024 is almost useless now because the scale has changed so dramatically. The Interactive Brokers account analysts often point out that Tesla's vertical integration, owning the supply chain from battery cell production to software, is what allowed them to survive the supply chain crises that crushed other manufacturers. This historical resilience is what gives them the premium valuation. They have proven they can execute in a crisis. Moving to the future outlook, we have to talk about the risks. The biggest risk right now is not demand, it is execution on the robotics front. If the Optimus bot